Imagine sitting at your kitchen table at 11:47 p.m., credit card statements fanned out in front of you like a losing hand of cards, your phone calculator showing a number that makes your stomach drop, and somewhere in the back of your mind, a thought surfaces that feels equal parts brilliant and terrifying. What if I just took the money from my 401 kek and made all of this disappear tonight? If that thought has ever crossed your mind, or if it's crossing your mind right now, I need you to subscribe before you do anything else, because what I'm about to walk you through over the next 20 minutes could be the difference between a decision that quietly ruins the next 30 years of your financial life and one that actually sets you free. And those two outcomes look almost identical from where you're sitting right now, which is exactly what makes this so dangerous. The reason this question feels so seductive is not because people are bad at math, it's because debt has a psychological weight that retirement savings simply does not, and the human brain is not wired to treat a dollar of future money the same way it treats a dollar of present pain. And financial institutions have known this about us for decades and have built entire business models around it. When you owe $18,000 across 4 credit cards and you have $24,000 sitting in a 401k account, the logical part of your brain sees a solution so obvious it almost feels stupid not to take it. And yet the very clarity of that solution is one of the most reliable warning signs in all of personal finance, that something important is being left out of the equation. The thing being left out is not a small thing, and it is not a thing that shows up on your credit card statement or your 401k balance screen. And that invisibility is precisely why so many people make this decision and spend years afterward trying to understand what went wrong. To understand what actually happens when you cash out a 401 kek early, you have to start not with the financial mechanics, but with what a 401 kek actually is at its most fundamental level, because most people have been conditioned to think of it as a savings account with a weird name and some restrictions, when in reality it is something far more powerful and far more fragile than that. A 401 kek is a legally protected, tax-advantaged compounding engine that exists specifically to take advantage of something called time, not time in the abstract, motivational poster sense, but time in the ruthlessly mathematical sense, the kind of time that turns $24,000 into $180,000 without you ever contributing another dollar, assuming a completely average market return over 30 years. And that transformation is not magic and it is not luck, but it is dependent on one condition that cannot be negotiated or recreated once it is broken, which is that the money has to stay inside the account and keep compounding without interruption. The mathematics of compounding are well understood but almost universally underestimated, and the reason they are underestimated is that human beings are naturally linear thinkers living inside an exponential process, and that mismatch between how we think and how money actually grows is the source of almost every catastrophically bad retirement decision ever made. If you take $24,000 out of your 401k at age 35, you are not losing $24,000. That framing is technically accurate and profoundly misleading at the same time, because what you are actually losing is the full compounding trajectory of that $24,000 over the next 30 years. And at a conservative average annual return of 7%, that trajectory ends at approximately $182,000 in today's dollars, meaning the real cost of the withdrawal is not $24,000, but somewhere between $150,000 and $200,000, depending on your age, your expected return, and how long that money would have had to grow. And that number never appears anywhere in the withdrawal paperwork, because if it did, the decision would look completely different. But the compounding loss is not even the first thing that happens when you initiate an early 401 kek withdrawal, because the first thing that happens is taxation, and the taxation on an early 401 kek withdrawal is structured in a way that is genuinely shocking to most people the first time they see it laid out clearly. The IRS imposes a 10% early withdrawal penalty on any distribution taken before age 59 and a half. And that penalty is applied in addition to not instead of ordinary income tax, which means the money is taxed as if it were a paycheck, pushing you potentially into a higher tax bracket for that year. And when you combine the penalty with state and federal income tax, the effective rate on that withdrawal often lands somewhere between 30 and 40%, depending on your income level and the state you live in, which means the person who withdraws $24,000 to pay off debt does not receive $24,000. They receive somewhere between $14,400 and $16,800, and the remaining $7,200 to $9,600 is immediately transferred to federal and state governments as a fee for accessing money that was legally yours in the first place. So, the actual transaction being proposed when someone considers cashing out their 401k to pay off debt is this. You permanently remove between $150,000 and $200,000 of future wealth from your retirement trajectory. If you pay between 30 and 40% of the withdrawal in taxes and penalties, and in exchange you receive a lump sum worth roughly 60 to 70 cents on the dollar that will eliminate a debt balance that, in most cases, could be addressed through other means with significantly less collateral damage, and when the decision is framed that way, the brilliant solution that felt so obvious at the kitchen table starts to look considerably less brilliant and considerably more like a financial emergency masquerading as a financial strategy. This is the part of the conversation where most people push back, and the pushback usually sounds something like this: "But you don't understand how high my interest rates are." And that pushback is legitimate and worth taking seriously because high-interest debt is not a trivial problem, and pretending otherwise does not serve anyone. Credit card debt at 22, 24, or 28% annual interest is genuinely destructive and genuinely urgent. And the compounding that works so powerfully in your favor inside a 401k works with equal ferocity against you when it is attached to a credit card balance. And there are situations, real situations, not hypothetical ones, where the interest being paid on consumer debt actually exceeds the expected growth inside the retirement account. And in those situations, the math does begin to shift, which is why this conversation requires precision rather than ideology, and why anyone who gives you a blanket answer without knowing your specific numbers is giving you noise dressed up as advice. The honest framework for thinking about this decision involves comparing three numbers against each other with genuine rigor: the after-tax cost of the withdrawal, including the penalty, the interest rate on the debt being eliminated, and the expected long-term return of the 401k investments. And while that comparison is never simple because it involves projecting future returns that are inherently uncertain, the directional answer is almost always the same once you do the full accounting, because the 10% early withdrawal penalty alone, before taxes, represents an immediate, guaranteed loss of 10% that no credit card interest rate, however high, can fully justify. When you factor in the decades of compounding being permanently sacrificed, and the people who have done this math honestly and completely almost universally arrive at the same conclusion, which is that there are almost always better options available that do not require destroying long-term wealth to solve a short-term problem. Those better options are not always easy, and they are not always fast. But they exist across a spectrum wide enough that most people can find at least two or three worth exploring seriously before concluding that the 401k is the only path forward. The first and most underutilized option is a 401k loan rather than a 401k withdrawal, and the distinction between those two things is enormous. A loan allows you to borrow from your own account and repay it over time, typically up to 5 years. And while the money is out of the market, you do lose some compounding growth during that period. You do not pay the 10% penalty, and you do not pay income tax on the borrowed amount. And you repay the loan with interest that goes back to yourself rather than to a lender, which means the actual cost of this approach is dramatically lower than an outright withdrawal, even though it involves the same account and the same money. Beyond the 401k loan, there is the landscape of debt consolidation and balance transfer options that many people underestimate or dismiss without fully exploring And while these tools are not universally applicable and come with their own set of risks and fees, a 0% balance transfer card with an 18 to 21 month promotional period can transform a 24% interest problem into a 0% problem for long enough to make significant principal progress without touching the retirement account at all. And for people with reasonably good credit who have not yet gone delinquent on their accounts, this option alone can dramatically change the math of the situation without requiring the permanent destruction of compounding wealth. Similarly, personal loans from credit unions or online lenders often carry interest rates between 8 and 15%, and consolidating high-interest credit card debt into a lower-rate personal loan does not eliminate the debt, but it materially changes the trajectory of repayment in a way that can make the 401k option completely unnecessary. There is also the conversation that almost nobody wants to have, which is the income side of the equation, because most debt elimination plans are built entirely around the debt itself and ignore the fact that the variable most within your control is not necessarily your expenses, but your income. And a single year of intentional, aggressive income expansion through freelancing, overtime, a part-time role, or selling assets can generate enough cash flow to address a debt problem that might otherwise feel immovable. And that path leaves the 401k completely intact and adds no new complexity to your tax situation and preserves every dollar of future compounding that the retirement account is capable of producing. The systemic reality underneath all of this is that the impulse to cash out a 401k to pay off debt is not a personal failure or a sign of financial ignorance. It is a completely predictable response to a financial system that has made it remarkably easy to accumulate consumer debt and remarkably difficult to build wealth. And the industries profiting from each side of this equation have very little financial incentive to help you understand the full cost of the transactions they are facilitating. Credit card companies profit from the debt, and 401k administrators process the withdrawal paperwork without being legally required to explain that the $24,000 you are taking out today will cost you $182,000 in retirement. And the gap between what these institutions are required to tell you and what you actually need to know to make a fully informed decision is the space in which most of the damage happens. And it happens quietly and without drama, and usually without anyone ever understanding exactly where the money went. What this means practically is that the people best equipped to navigate this decision are not the ones who are smartest or most disciplined or most financially literate in the abstract. They are the ones who have built the habit of slowing down when a financial decision feels urgent and obvious, because urgency and obviousness are two of the most reliable signals that the full cost of something is not yet visible. And the moment you feel the strongest pull toward cashing out the 401k is almost always the moment when you are seeing the debt most clearly and the future cost of the withdrawal least clearly. And that asymmetry of visibility is not a coincidence, but a feature of how financial stress affects the brain's ability to process long-term consequences. The research on financial stress and decision-making is actually quite clear on this point. Cognitive load imposed by financial scarcity measurably reduces the bandwidth available for long-term planning, not because people under financial stress are less intelligent, but because the brain under pressure allocates resources toward immediate threat resolution at the expense of future modeling, which means the person sitting at the kitchen table at 11:47 p.m. staring at credit card statements is physiologically less equipped to accurately assess the 30-year cost of an early withdrawal than they would be if they had slept well and were not under pressure. And that is not a moral judgment, but a neurological fact that has real implications for how and when this decision should be made and who should be involved in making it. The identity dimension of this conversation is the one that rarely gets addressed in financial content, but it may be the most important one because the question of whether to cash out a 401k is never really just a math question. It is a question about what kind of financial actor you believe yourself to be and what kind of future you believe is available to you And people who cash out their retirement accounts to pay off debt often do so not because they have done the math and concluded it is optimal, but because they have internalized a story about themselves as someone who cannot get out of debt any other way. And that story is almost never accurate, but it is extremely powerful, and it shapes every financial decision made downstream of it. The shift that actually changes outcomes over the long term is not finding the perfect debt payoff strategy, but developing the capacity to sit with financial discomfort long enough to see more than one option, to resist the gravitational pull of the obvious solution long enough to ask whether the obvious solution is actually the best one, and to treat your future self as someone whose interests matter as much as the relief you are trying to create tonight. What the data shows, consistently and across income levels, is that people who preserve their retirement accounts, even while carrying consumer debt, end up in materially better financial positions at retirement than people who drain those accounts to achieve a debt-free status that, without accompanying behavioral and systemic changes, often does not last because the debt was a symptom of something and the 401k was a solution to something. And eliminating one without addressing the underlying dynamics tends to recreate the problem over time while permanently reducing the resource available to solve it. And that pattern is not a personal failing, but a structural outcome that plays out with remarkable consistency across the population of people who have made this choice. The calm truth at the center of all of this is that financial decisions made at 11:47 p.m. under the weight of a full spread of credit card statements are almost never the right decisions, and the 401k will still be there in the morning, and the debt will still be there in the morning. And the difference between acting tonight and taking 2 weeks to fully map out every available option is the difference between a decision made with 30% of the relevant information and one made with 80% of it. And that gap in information quality is worth far more than the emotional relief of feeling like you did something. There is a version of your financial life where you eliminate the debt without touching the retirement account, and it may take longer than tonight, and it may require more creativity and more discomfort than a single large withdrawal, but it preserves the one asset that the financial system is least equipped to replace once it is gone, which is time in the market, compounding quietly on your behalf, building a future that is still possible if you leave it alone long enough to do its work. If this kind of calm, honest breakdown of financial decisions is what you have been looking for, subscribing takes 2 seconds, and it means the next time you are at that kitchen table at 11:47 p.m., you will already have a framework for thinking through what you are looking at, and that framework, more than any single decision, is what actually changes where you end up.